Hi everyone, welcome to this week's edition of Midweek Market Update. I'm Ashley Rosser with Victory Fiduciary, and today we're just going to talk about just the continued uncertainty that we're seeing within the economy, within our recovery, what seems to kind of continue to just threaten the recovery, and what we remain certain about is the fact that we have increasing levels of uncertainty. And so, we've talked for many weeks that one of my biggest concerns about the market has just been the fact that when you price in, a perfect paradise recovery, you leave no room for error and you leave no room for disappointment. And that means that, markets can be disappointed quickly. And so what we're just seeing right now is just, again, additional effects of the fact that most likely our recovery is not going to be a perfect V. There's absolutely going to be bumps along the road. We're seeing them now. And so today we got our weekly new unemployment filing claims above 1.1 million. Now, they're the lowest that they've been since we started this pandemic back in March. But we're still today filing 1.1 million new claims a week. And that is staggering to think that this far in, as we're supposed to be in the midst of recovery, and there are still 1.1 million Americans going out and filing for first unemployment benefits this week. I mean, it's baffling, it's staggering, and it's concerning. And so tomorrow we're going to get our monthly new jobs update. And I expect that it's likely that tomorrow is going to be a disappointing day when we look at these numbers. May and June, we saw that we had sizable jobs being added back into the workforce. That was because many people who had been furloughed were going back to work. And unfortunately, I think that it's likely that we're going to see much less positive numbers tomorrow, as since that time there have been many states who've had to backtrack their reopenings. We've seen many areas, especially when we look at things like hospitality, having to close back down or having to decrease the number of staff that they need just because they're not able to operate, in some areas even at half capacity. And so I think we're going to see that many of those jobs that were added in those last 2 months are probably, for right now, that they're gone again. And I would say that an article that I read today kind of supports that theory. That I saw that Cornell University did a study, and they're estimating that 31% of people who lost their jobs during the pandemic and then at some point went back to work have now lost their jobs again. So think of that for a second. So 31% of people who went back into the workforce after being temporarily laid off no longer have a job right now. And of those who've gone back to work, 26% have been told that their jobs are in danger. And so again, this is a huge level of uncertainty that we have when we look at the recovery in our economy. We saw the GDP numbers negative over 32% for second quarter. I mean, these are numbers that we haven't seen since the Great Depression. And so I just think, there is still significant uncertainty, and, whether or not the market is disconnected from that, I think that eventually that's going to all kind of come to fruition. So we just continue to remain uncertain. And I just wanted to share with you a chart about the NASDAQ. So you might remember that 2 weeks ago I was talking about the divergence from the 200 moving day average and how far above that we were trading above that. And if you can kind of see here, so this was 2 weeks ago, and I kind of said, listen, if you're heavily invested in NASDAQ stocks, then you might really want to consider taking some risk off the table, maybe taking some profits, because we can't trade here for very much longer. A reversion has to come. And that was just because of how far we were trading above our 200 moving day average. That's that orange line right here. Well, we saw a sell-off that happened actually we had that statement made on Wednesday, and by Thursday the NASDAQ had begun to sell off, and it did a pretty significant sell-off here. Well, we're right back up to being hyper overextended, folks. When I tell you that we are trading 23% above our 200 moving day average, I mean, it's not sustainable. We're 3 standard deviations above where we should be. And the reason that this is so important, so when we have moving averages, they act like a gravitational pull back to them because that's the average. So that's where we will trend. Sometimes we'll be a little above or sometimes we'll be a little below. When we get too far deviated from there, those averages will pull them back. And so right now, we are so far away from our average that is going to have a reversion. And so that's just something to look for. So if you're heavily invested in NASDAQ-like stocks or some of the areas of technology, you may want to consider taking some profits off the table because I think it's likely that we're going to see a short-term reversion, certainly. And I use the example that it's almost like there's times that the markets get so overstretched, overextended, it's like stretching a rubber band as hard as you can. There may be a little bit of stretch left in the rubber band, but eventually it's going to snap, and it's going to snap back just as hard as it was pulled. So just something to think about. I think it's really important right now where we are within the markets, making sure that we understand what our risk to reward ratios are, understanding that in many areas of the market, the S&P 500 is included as well. Upside potential is really, right now, it's not outweighed by the risk that we see right now. The S&P 500, markets in general this week have actually done very well. Today's the first day that they're very muted, they're paused, and I think that has a lot to do with the fact that we're waiting to see what's going to happen with this unemployment benefit that is about to run out. We're waiting to see what kind of stimulus packages may or may not come out with this. And I really thought that last week when I did my next video this week that I would be discussing with you what was passed, what was in it, and kind of unpacking how that was going to impact both individual investors as well as the market in general. And here we are without a deal. And so time is kind of ticking. I think the market's beginning to get uneasy with the fact that we don't have a deal. And while both sides keep saying, we'll get it done, we're getting closer, they're trillions of dollars apart from each other. Trillions. I mean, I don't even think we can really know what it means for a trillion of anything. It's a very, very, very large number. And they're trillions away at this point with the deal. And so I think that in the short term, if a deal is not made in the very short term, I think certainly within the markets that is going to have a pretty negative impact pretty quickly. Because again, that's money that's $600 a week per those who are unemployed that is no longer able to go back into the economy. And I think that we're going to see things like liquidity in the market freeze up very quickly. And so it's a concern. So the markets today have been very muted. They've hovered between, being slightly down, slightly up, right at break even. And so I think the next couple of days are going to be really telling with that. And so with the S&P 500, though, like I was saying before, they continues to be disconnected from reality, disconnected from corporate earnings, disconnected from the economy, disconnected by what our current unemployment landscape is. And that's really because the S&P 500 is being propped up by 5 stocks still. So we've said before that the S&P 500's return year to date is, they can thank Facebook, Amazon, Apple, Google, Microsoft, and Netflix. So those are the stocks that essentially are responsible for having a positive return. The rest of the 195 companies in there have negative 5% or greater negative performance for the year. So we're really being carried. Apple right now, 6.5% of the S&P 500 is made up by Apple. So again, one company. These are concentrations that we've really now never seen. We are so hyper concentrated. Not a sign of a healthy market. Not a sign when you realize that indicates that there's significant weakness with the rest of the companies that are there when you're being carried by such a small amount of companies. Just something to keep an eye on, be careful of. Understand that it's okay to take profits off the table to mitigate risk. We talk a lot about we only want to take as much risk as we need to, and if that means that we have to be defensive for a period of time and be able to make that up later, we will. I'm going to show you kind of how that works. But again, so NASDAQ, again, just trading very, very high divergence right now from its 200 moving day average. S&P 500, which by the way, the S&P 500 is only 2% away from hitting an all-time high, if you can believe that, with where we were back in March. I think it's pretty likely that probably in the next week or so, the S&P will probably hit that new time high. We're so close. And what happens is the markets so desperately want to hit those points when we get there. I think that it's very likely that we will hit it and then see a correction very shortly after that, especially historically August, September, the weaker months in the market to begin with, combined with kind of all of these other challenges. So I think it's very likely in the S&P that we could see correction 5-10%, and then depending upon what else is going on, I mean, those numbers could be more than that, certainly. So just things to keep an eye on when you're looking at your portfolio. And greed remains at an all-time high. We talk about, I talk a lot about what's the risk versus reward. And so right now, there's a lot of signs right now that we're at the top of a market right now, that people are kind of chasing that last bit of performance. When we get to areas of extreme greed, where investors are literally willing to kind of throw caution to the wind, and then we can see, so this is our greed tracker here, then kind of how it follows along with the S&P 500. And every time we get to the top of a greed cycle, there's always that significant reversion usually that comes after, because that indicates that we're at a market high. And we see a lot of things out there that make us concerned that markets are very quickly going to be at a tipping point in the near future. And typically when markets get set up the way that they are right now, it just takes that outside catalyst to kind of start the cascade of moving through and seeing that correction. And so what that will be, I don't know. I don't think it's going to be coronavirus necessarily, or even rising coronavirus cases. I think, though, that it certainly could be additional challenges reopening if we have to pause, or if we have to go back to a shutdown, even on state levels. I think that could definitely trip the market up short term. I think that different trade challenges that we have, and if those negotiations go south, we see increasing pressure from places like China. I think that those are things that could rattle the market. There's a lot of uncertainty with the election right now. We haven't really talked about that. And so I think that we don't really know. That's the thing. You don't ever know what that outside force is going to be. It's not until it comes and the market corrects then we're able to kind of point it out. So just know, risk right now is super high in the market. There's not a ton of opportunity there. So just kind of be aware of those things. But what I did want to talk about, so last week I told you that we did re-enter the market the week before, that we had taken 3 positions at 5% each. And so I just kind of wanted to talk to you about those positions a little more, and kind of how they're doing when we look at compared to the broad-based indexes, and just to kind of explain just really what the value is of using relative strength when you're creating a portfolio. And so this blue line here would be the S&P 500's return since we took positions back July 23rd. The orange line here would be our tactical model's performance since that time was positive 1.42. And this red line up here would be the cumulative return of those 3 funds over that time. So the S&P was up 2.19. Those 3 funds together were up 8.26 for that same time period. And so this is just a really powerful reminder that if you can be in the right areas of the market, if you can be very tactical, very focused, finding the areas with positive relative strength, positive momentum, areas that are not at a market top, and areas that are not overbought, then you can have significant performance without having to take on risk. So this model here that is, tracking the S&P 500 right now, this model has 50% bonds, 35% cash, and 15% equities. And so again, being able to say that we're still trying to minimize risk at this point, because we do believe that risk outweighs reward in a lot of areas, yet the S&P 500, that would be 100% equities. So significantly less risk in terms of when we look at the equity exposure, definitely outperforming the indexes. And that's the idea, that over the long run, we want to be able to outperform these benchmarks by finding the right areas and by using our program. And so this is just, I think, a really visual way to kind of show you. Will there be corrections and retractions in these areas? Absolutely. When that happens, we'll use those opportunities to increase our holdings and then add additional holdings. And so just wanted to show you, so these are how the models have done just since we've taken positions. And so we're looking forward to being able to increase positions, but again, to be able to do it prudently, to kind of take our time. But this is how it also is it allows us to make up ground faster than the indexes. Once we have confirmation that we should be there, then we can make up ground fast. The idea is that we usually will lag indexes when we're defensive for a period of time. We have patience, and that's just the way that it is, because we have to wait for confirmations. But when those confirmations come, we have great opportunity by making sure we're in the right areas. So just wanted to go over that with you. And so really, so in summary, there are many areas of the market that are kind of flashing that we should at least be paying attention to risk within our portfolios, try to take some off the table if we can. Again, hopefully next week we'll be talking about what the new unemployment benefit and stimulus bill that was passed, and we'll be able to unpack that. But otherwise, I hope you have a great rest of your week. And if you have questions, you can always email me at ashleyer@victoryfiduciary.com. Stay well and have a great day. Thank you.